That's a positive divergence right there between the double bottoms.
That's right. Right there.
Yep, right there and right there. So you
Yep.
got a really low low, and then you got a higher low. So that shows a potential positive trend. And guess what? Sure enough, right after that, bam.
Welcome to Mental Capital Investing. Thank you for joining us. We're all about showing you how to build trading and investing strategies from the ground up. We are your hosts, Jeff and Spencer, and today we want to talk about how to choose technical indicators to use to develop your own strategy.
Yeah, technical indicators are one of the strangest parts of investing because although it is foundationally established in statistics, what you are actually measuring is the psychological tendencies of investors. Speaking of psychological tendencies, I think one of the best psychological tendencies is to hit that like button. So, if you wouldn't mind having an awesome psychological tendency to hit that like button, I would really appreciate it.
That's right on both accounts. And the most important part of this whole process is actually to be picking the indicators that are meaningful to you. And I know that sounds a little woo-woo, but let me explain. First, we have to understand what indicators are and why we use them. So any chart consists of 3 different streams of information. Price, as you can see here, volume, and time. So the x-axis on the chart. The purpose of any indicator is to give you a different perspective on one or more of those factors. And this enables us to see qualities in the price movement that we may not notice otherwise. Patterns emerge between these perspectives, and out of that, we can build trading strategies.
So keep this in mind about this, though. This is not just useful for trading, but also investing. Time scale matters. It is so important. I see so many new traders and investors, they misunderstand time scale. Okay. Basically, time scale matters when you're examining any strategy. It also determines how reactive you need to be to the market. A long-term investor, for example, they may be watching for indicator signals on the daily or even weekly charts. However, somebody who's looking at swing trading, they may be examining the hourly or even the 15-minute parts. Probably get into this a little bit more later, but it's important to understand that the events that happen at lower time frames cascade into larger events on the longer time frames. And longer time frames generally have a little bit more permanence in terms of trends.
And the reason those trends persist, especially on the longer time frames, is because that's where the big money plays. The big money plays in those longer time frames. And so when they move on those bigger time frames and they affect everything else. So to use an indicator effectively, you have to understand it, what it does, how it's calculated, and why it works. You should be able to answer those questions at least before using an indicator in a strategy. And this is where our first problem comes in. There's so many indicators to choose from that it can be hard to know where to start or how to pick one. For this, there's really no better solution than hard work. If you're new, start by looking at a wide range of indicators. As you do, you might find one that clicks, one that you intuitively understand a little better than the others. And this can be as simple as thinking, oh, hey, this one sounds pretty cool. Or you can have firsthand experience with the subject matter an indicator is based on.
So I'd like to interject here real quick and say that although you may find an indicator that you feel like looks cool, and even if you do the math, you really understand it at a fundamental level, nothing beats using it and getting that experience and trying to build that training regime in your mind of, I've seen this indicator react this way to a few different stocks in the past, so that's how I know that right now it's probably going to bottom out. And this might be a good value entry. That's just an example of maybe some imaginary indicator in my head, but I'm trying to illustrate that sort of experience level that you kind of get from practice and using an indicator over time and constantly watching it and getting that good vibe with it. Keep in mind that in this channel in Mental Capital Investing, we're going to be covering a lot of indicators in great depth. We've already covered two of our favorites, MSA and Sigma Spikes, that we use a lot. Yeah. So, Spence, please continue.
Yeah, man, and there's no substitute for experience. Once you do, that's exactly the next step you want to take once you've picked your indicators. But one thing to remember when picking those indicators is to maybe avoid choosing ones that don't necessarily, that do basically the same thing. So take the RSI and the Williams percent range. You can see those up on the chart here. Both are momentum indicators. Now, they do look at momentum a bit differently, different calculations underlying there. But unless you have a good reason, you probably don't need more than one momentum indicator on your chart. So the next thing to do is to think about what priority you want an indicator to have. Are you looking for a main indicator that you'll use to generate signals? Or are you looking for an indicator to help with confirmation or setting price targets? You want to choose indicators that answer questions for you other indicators don't.
Yeah, you got to remember though. I mean, I got to point out there again on the time frame business. The longer time frames have more permanence than the shorter time frame moves because they're aggregates of way more data points. So a lot of times people get stuck in their first time trading. They're looking at the 5-minute chart. And they're looking at all the crazy action on the 5-minute chart, and they're getting sucked into it. And they're like, wow, this is crazy. Look at all this action. Take a minute, zoom out from the 5-minute chart, and see the impacts on the 1 hour or the daily. And you're going to find out that the movement on the 5-minute is pretty much minuscule and almost doesn't even matter. That's why you trade the longer time frames. But you got to look at the shorter time frames to give you an indication of what the longer time frames may do. And this is the same with any indicator. Is there any way you can show us that real quick on your charts?
Sure. So
maybe give us a look at like a 5-minute and show how it may move into like a 30-minute and maybe a 1 hour, maybe a 1 day, maybe at a dip or somewhere.
Let's start on the 5-minute on the S&P futures here. This looks like where we got a few different little bounces into oversold on the RSI, same up and down the range in the Williams percentage range. But then let's jump up to the 30-minute, see if you get the same kind of bouncing around. And that whole portion of that data is now captured in this section of the 30-minute chart. And you're not seeing any of that, any of those signals that you would have seen on the RSI on this shorter time frame. You see a few here on the Williams percent range, but you don't see it on the RSI. Let me jump up to the, say, 1 hour. Let's go 4 hour here. And again, all of those data points that were kind of split up in that 30 minutes are now really in just a couple of bars here. And you can see that they're more or less right in the middle of the RSI, and the Williams percent range actually does give what is potentially a signal, but you can see that it's much more compact and it doesn't actually give you a whole lot of information on that higher time frame, or a whole lot of signal on that higher time frame.
Awesome. Yeah, I think that's a great way to look at it. So just remember, everyone, don't get sucked into the lower time frames and trade the lower time frames. You want to make good value buys on your investments. You want to make good trades. Trade the longer time frames.
Yep. And finally, remember, nothing in trading works 100% of the time. So all the rules of thumb that we just described, they have exceptions. In fact, people have probably found out how to make money by doing the opposite of what you do. So there's all kinds of rules in trading that can be broken at any point in time, and it's just really important to forge your own path and do something that works for you.
I would say that's another reason when you do find indicators that you really enjoy using that work for you, really understanding them and building that experience with them will help you understand when they're actually being broken. Me personally, I'm a fan of using RSI. I really enjoy it. I like looking at the overbought and oversold levels, at the 30 mark and the 70 mark, and sometimes at the 80 mark as well. But even me, I know you can have a situation like GameStop where the market hype is just at such an extreme level that even though the signal is at overbought levels around 95 or even 100 on RSI, the fluctuation and market pressure is just so extreme that it sort of breaks every rule that the RSI sets as an indicator and says, you know what, just because it's overbought doesn't mean it's going to bounce down and recover.
Yep.
And
That's
so,
right.
to my case in point, it's just these indicators are not foolproof, right?
Absolutely.
And you got to combine them.
One of the things, yeah, exactly. So you can combine to create some complex rules to keep you safe and honest. But and you've alluded to, Jeff, how you want to actually get real experience with an indicator to kind of basically pick out patterns that may or may not be profitable. But one of the things we're going to do in some future videos is actually talk through how to properly run back tests so that you can get truly familiar with a set of indicators and the signals that they generate. This can be done by manually back testing, like you said. This can also be done by data mining and doing some programming around understanding how those signals generated and what the forward returns of those signals are by using some different programming techniques. But we're going to talk about those things as well.
Could also be done just by simply looking at divergence between peaks, which is a common thing to do.
Oh, absolutely. Yep.
I mean, you can even see that on this chart right here. If you look at the double bottom on the Williams R percent and RSI, right between the 20th and the 23rd, that's a positive divergence right there between the double bottoms.
That's right. Right there.
Yep, right there and right there. So you got a really low low, and then you got a higher low. So that shows a potential positive trend. And guess what? Sure enough, right after that, bam.
Now,
look at those green candles. Delicious profits.
And what data mining can tell you about these divergences, these patterns that you notice in your indicators, it can tell you every time they happened in the past, how profitable were they? Were they, and how successful were they? How often are they accurate? And so, again, it's just, there are multiple ways to get familiar with these indicators so that you know when you're trading live and you're facing all that uncertainty, what the right move to make is.
Awesome. Well, that concludes our video for today. If you have any further questions about this topic, please put them in the comments below. If there's some indicators you really want us to cover or something you're really interested in and want us to dive deep into the math, the statistical references regarding those indicators and how we think best to use them, please let us know. Put it in the comments. We'll make a video about it. Happy to hear your feedback. Thank you very much. Please like and subscribe for future content.
Cheers.
Cheers.